Hi there, I'm Michael from Bennison Brown Mortgages. Thank you for taking the time to watch this video. This video is designed for first-time buyers to give them all the key information they need on the property purchasing process from end to end. By the end of this video, we want to put you in a better position so that you understand the process and can move forward with purchasing your first home in confidence. This video is designed for first-time buyers. In particular, people that have maybe been planning to purchase a property now for a period of time and are not quite sure of the next steps. Maybe you're renting at the moment and you're concerned about the cost of living crisis and subsequent increase in rents, and you want to make sure you're paying your own mortgage rather than someone else's each month. Perhaps you've been researching the property market and you're not quite sure on who to turn to for trusted advice next. Maybe the mortgage market and purchasing a property is confusing to you and you want to get a clear understanding of the market, the processes and all the subsequent next steps from there. And maybe you've been saving for a long time now and you're ready to put those savings to good use and purchase your first home. Whatever your circumstances, hopefully this video is going to be useful in helping you understand that process in a lot more detail. In today's video, we'll go through the process in 5 sections. Initially, we'll focus on understanding, covering both an understanding of your own circumstances and also mortgages. Firstly, we'll focus on your own circumstances, as these will determine how much you can borrow, what deposit you require, how much you can afford to pay on your mortgage each month, and ultimately what this means for a purchase price. Initially, we recommend that you get a copy of your credit report. The credit report is going to give us details of your current credit commitments, such as your monthly payments and the level of debt. It's important that you understand this, as the mortgage lender will take these into account when they calculate what mortgage amount they're prepared to lend you. You also need to factor this in when you consider your monthly budget for your mortgage payments. As well as detailing the current level of commitments, your credit report will also highlight any adverse credit, such as a missed payment, a CCJ or a default. The level of any adverse credit will determine when you're ready to apply for a mortgage. Adverse credit may mean that some mortgage lenders aren't prepared to lend, so it's really important, if you do have any adverse credit, that you speak to an expert. As well as speaking to an expert, you may find sometimes the adverse credit is on there by mistake, and finding out this early in the process allows you to correct this and speak to the people that have made that mistake. So once you've reviewed your credit report, the next section to consider is your deposit. Think about the level of deposit that you've got available at the moment, whether that's from your own savings or gift from family. And then you can start to put a saving strategy in place to make sure that you can hit the goal that you require. By having a clear goal in place, it can help you keep you motivated and make sure that those savings continue to grow. Another factor that will come into play is your employment status, particularly if things are changing. So perhaps you're waiting to start a new job, or you've been told that you're going to be getting a pay rise in the future. This additional or increased income could potentially lead to a higher borrowing amount, so it's important to understand when that will be taken into account by a lender and whether you want to wait for this to take effect. Perhaps things have changed in terms of employment status going from employed to self-employed, or maybe you've started contracting. There's lots of lenders in the UK that are willing to support people that are going through changes, and it's important to understand the market so that you get access to the right lenders for you. And this is where an expert can come in to help you understand those options in a lot more detail. And the final point that we wanted to talk about was the property that you're potentially looking to purchase. Even something simple about that property, such as maybe it being a high rise or above a commercial shop, or maybe it's a property with an annex in the garden. Even those simple little things on your dream home can determine whether a lender is willing to lend or not, as not every lender has the appetite for every single property. So understanding what types of property that you're looking for and which lenders are going to be willing to support that is important in understanding your circumstances and determining how much you can borrow. As a first-time buyer, lots of these circumstances will apply to you, and it's really important that you understand those and the impact of those and the mortgage lenders that are going to be available to you going forward. Now, once you've got an understanding of your current circumstances, the next step is to understand how you're going to purchase the property. There's many different ways you can purchase a property, and I've highlighted three ways which we're going to talk through in more detail. So option 1 to talk through is the standard way, and this is the way the majority of people in the UK purchase a property. You purchase 100% of the property and you'll need a deposit which is typically 5% or higher, and the mortgage lender will lend you the rest of the money. There's no restrictions on the property, so whether it's a new build or a second-hand property, and whilst you need a 5% deposit, typically the higher the deposit you have, the better rate you're going to be able to achieve on your mortgage. So another option to consider is the shared ownership scheme. The shared ownership scheme is a government-backed scheme where you buy a share of a property which is typically between 25 to 75%. By not having to fund 100% of the property purchase price, it means you'll need a smaller deposit and a smaller mortgage, and this may open up more properties than available to you through a traditional route. You will need to factor in that you pay rent on the share that you don't own, so this will be impacting your monthly budgeting as well as also the mortgage amount, as a lender will also factor in this rent commitment. Shared ownership is only available on specific properties, so it's not available on every single property in the UK, such as when you're buying through the traditional route. Once you own the property, you can potentially purchase more shares in the future, which is called staircasing, and you can staircase to 100% ownership as and when the time is right for you. As well as factoring in the cost of rent, the ever downside to purchasing through shared ownership is that you only own a set percentage of the property, and therefore the growth in value is based purely on the share that you own, not the full share of the property value. And then the third option that I wanted to talk about was to purchase with a 0% deposit. At present, this is only available through one mortgage lender, and they'll need mortgage payments to equal the amount of the rent that you've paid in the last 12 months. Whilst there's only one lender that offers this scheme, there are various other schemes available with regards to clients that have a small deposit looking to make that first-time buyer purchase. So now that we understand your circumstances and the potential ways in which you can purchase a property, the next step is to consider some of the likely costs that you may incur. And on the screen are 4 main costs to consider. So number 1 is the legal costs. You're going to need a solicitor and conveyancer to complete the legal work for you, and we anticipate the cost for this to be around £1,500 to £2,000. We'd always recommend that you get free quotes to make sure that you've got a competitive price. But whilst price is important, it's also important to consider the level of service that you're getting. The process in purchasing a property is time consuming, and it's not unusual to get hit with issues and delays along the journey, so having a trusted professional in your corner can be vital. So making sure that you pick the right solicitor or conveyancer for your circumstances is crucial in determining how successful your journey will be. Now, once you've found a property, you're going to want an expert to tell you the truth about that property, warts and all. We'll discuss the different level of surveys that are available later on in this video. However, we'd budget somewhere between £400 to £1,500 to get a good survey done. The third cost on the list is a broker fee. Navigating the mortgage market is a complex journey, and a mortgage broker will help do this with a lot more ease. They'll help get you the best mortgage for your circumstances, whilst also ensuring the application to the lender is successful. They'll help take the stress away from the purchase journey. A good broker will be on hand to answer any questions from meeting them to moving into the property. So we feel it's money well spent in investing in a good mortgage broker. Typically, a mortgage broker could charge you somewhere between £500 to £700, although there are firms that work for no fee. On the other hand, there are firms that charge up to maybe 2% of the mortgage value. So again, it's important to shop around and find someone that you're comfortable working with. And the final cost I've listed is stamp duty. Stamp duty is a tax you incur when you purchase a property, and it's based on the purchase price. The table on screen reflects the stamp duty rules from the 1st of April 2025. As a first-time buyer, the government have an incentive in place. A first-time buyer must be someone purchasing a property to live in as their main residence, and they must not have owned a property anywhere in the world before. If you purchase a property for £500,000 or less, then you'll not pay any stamp duty on the first £300,000. On an amount between £300,000 to £500,000, you'll pay 5%. So, as an example, if you bought at £400,000, your stamp duty would be £5,000. The benefit of reduced stamp duty for the first-time buyers is only applicable on purchases up to £500,000. If you go a penny over this amount, then normal stamp duties apply as per the right of this graphic. So now that you understand your circumstances, the potential purchasing options and the likely costs that you're going to incur, it's now time to start understanding mortgages. Now, in the mortgage market, there's a lot of jargon, and even a seasoned homeowner who's applied for multiple mortgages may not understand all of the terms. And to be honest, you don't need to understand them all either. But there are some key terms that you do need to get to grips with, and a mortgage expert can help you understand those terms that are important to you. So firstly, mortgage term. It used to be that as a first-time buyer, typically you'd end up taking a 25-year mortgage, as that was the longest a mortgage lender was willing to lend. However, with property prices increasing and the population working longer, lenders have adapted, and now we can have mortgage terms for 35, 40 or maybe even 45 years. However, a mortgage term is really individual, as it's there to suit your budget and your lifestyle. We'd always recommend that we apply for the shortest term possible to make sure that you can repay your debt as quickly as possible. However, you don't want to be overstretching yourself. You still want to have the flexibility to go on holiday and to save and various other costs that come up in life. So it's important that it's there and it meets your budget. The next term on screen is a lender deal. A lender deal is a product that you take out for a period of time that gives you a special deal for the first 2, 3 or maybe 5 years of your mortgage. However, it could be longer. There's lenders that will even give you a deal for the lifetime of your mortgage. A variable rate or a tracker rate is a mortgage that has a variable rate that follows a set base rate, which is typically the Bank of England base rate, although it can be the lender's own specific base rate if they prefer. By having a tracker, the monthly payments will go up and down in line with changes to that base rate. And finally, a fixed rate, where lenders provide a fixed rate for a set period of time. This can provide comfort knowing exactly what your payments are going to be for a set period of time and can protect your monthly payment increasing should the base rate increase. And an assessment is where underwriters review your application, and we'll discuss this in more detail shortly. So now that you have a good understanding, it's about putting all of that into practice and preparing yourself to purchase a property. To do this, we're going to create a personal strategy. At this stage, you're going to have a clear idea about how you plan to purchase a property, whether that's using a lender's special scheme, whether it's a standard purchase, or whether it's going to be a shared ownership property. As well as this stage, you're going to need to know what level of deposit is going to be available, what your monthly budget is for your mortgage payments, and crucially, how much a mortgage lender is going to lend you. You'll also need to consider your long-term plans. You need your mortgage to fit what is going to happen in the future for you, so making sure that you understand what circumstances may change is going to be important so that you can select the right mortgage product for yourself. Over the next couple of slides, I want to show you how different clients can be treated by various lenders, and this results in various different loan amounts that are available. So I've taken a couple earning $94,000 in their earnings and no unusual outgoings. They've got a credit card balance of around £4,000 and they're buying a flat, so service charge and ground rent is going to be factored in by the lender in determining what they can afford. As you can see from the graph, the amount they are able to borrow varies significantly, all the way from $338,500 up to $517,000, and this will give them a widely different property purchase price depending on which lender they were to approach. And bear in mind, this is just based solely on income and outgoings without throwing in any other factors which could influence this further. To me, this highlights the importance of shopping around and not just to go to one lender and take in what they can offer. Now, typically when people talk about shopping around, they think about getting the best deal. And whilst that's important, crucially with mortgages, it's about finding the right lender for you, who can provide the right amount of borrowing at the best deal for you. Being able to approach all the lenders in the UK by yourself is nigh on impossible, and this is where having a whole of market mortgage broker comes into its own. Now, having found the right lender for you, the next important step on the process is to get an agreement in principle. We believe that by having an agreement in principle in place early, it puts you ahead of the competition when you find your dream home and you wish to make an offer. An agreement in principle is the first step on a mortgage application. However, for the majority of lenders, it is only a soft search. A soft search means there's no impact on your credit report, as only yourself and the lender that you've applied to can actually see that this has taken place. By having an agreement in principle in place, it makes you more appealing to an estate agent. It shows to them that you've passed a credit check. Potentially, if you've used a broker, then they've reviewed and verified your income documents. So again, the estate agent knows that when the application goes in, it should be successful. And it gives them complete confidence that you're going to be able to achieve a mortgage. An agreement in principle is typically valid for 90 days, depending on the lender. And it gives you the confidence that when you do find a property, you're going to be able to purchase that property without getting your hopes up and then finding out that things are unsuccessful. So now we're in a position where we understand your circumstances, we understand your mortgage capacity, it's onto the exciting bit of actually finding a property. When you start searching for a property, we'd recommend having a chat with some local agents to begin with. They've got some fantastic knowledge, so it's a great way to understand the area and determine exactly where you want to be looking. As well as using the local agents, we'd recommend that you use online portals such as Zoopla and Rightmove. They can help showcase all the properties that are available. Remember, some agents don't have a local office, so being able to view properties online as a starting point is a great start. Now, when you do start doing viewings, we recommend that you do view lots of properties. Include some unusual properties that maybe weren't on your initial thoughts. This can help focus the search and also help narrow down what are the non-negotiables on your property, what are the absolute essentials that your property must have, and by viewing lots of different properties, it can really help narrow down what you're looking for. And who knows, you may even find something that you weren't expecting. Once you think you've found your property, we suggest you take your time and do a number of viewings. Go again in different times of the day, review how busy it is on a weekend, on an evening. What's the parking situation like? Consider all of those things before you're ready to make an offer. So once you've found your dream property, it's then down to making an offer. And this can feel like a daunting part of the process. You don't know what to do. Do you go with what they've got the market on, or do you go higher or lower than that? And really, it comes down to individual circumstances. There's a few things that you need to consider. Firstly, how busy the market is at the moment. Are there ever properties of a similar style on the market that you could use as a fallback if this doesn't go through? And also consider from the seller's position. Have they just put it on the market recently? Has it been on the market for a long time? And what's their next move going to be? How badly do they need to sell this property? All of those situations will determine whether you want to go higher or lower than the asking price and what you might want to do. But remember, this is negotiations, and ultimately someone can say no, and you can always go back to the drawing table and go back with another offer. So now all the exciting stuff is out of the way and you're on your way to owning your first property. We come to a slightly more boring part of the process, but a part of the process that we really enjoy. It's the application stage, so we're going to need to look at the paperwork that you need to complete the mortgage process. So first of all, it's looking at the documents that we're going to need to provide the lender. So we're going to need to evidence your income. To do this, we could do it through your pay slips or your tax returns if you're self-employed, or your company accounts if you own a limited company. As well as your income, we need to evidence your expenditure, so we'll need to see bank statements and credit card statements and confirm to the lender the amount of outstanding debt that you currently have. We'll also need documents to verify your ID and the deposit that we're going to be using for the purchase. Depending on how complex the application is, we'll then also be discussing with the underwriter as they review the application form alongside your documents, and we may need further documents to evidence certain parts of the application form to satisfy the underwriter's requirements. Once the underwriter is happy with the application, they'll arrange for a surveyor to go out and value the property. You'll remember earlier in the video we spoke about certain properties not being right for certain lenders, and at this stage we need to know that we're applying to the right lender for a lender that's going to be happy to lend on the property that you've settled on. Now, assuming that your application is successful and the valuation goes well, you'll then be issued a mortgage offer. And it's a small time to have a small celebration, as you've now secured finance to purchase your property. There are, however, quite a few hoops still to jump through over the process. Typically, a mortgage offer is valid for 6 months, and this should give you enough time to complete all the legal work and finalise your purchase. Now that you've got your mortgage offer in hand, it's a great time to arrange your own survey to be done. As you'll have seen from the last slide, the mortgage lender may complete a valuation as part of the process. However, they're only doing this to make sure the property is adequate security for them to charge a mortgage against, not to decide whether it's a good investment for you and your family. When the mortgage lender does complete a valuation, they tend to do this either through their online resources, they may do a surveyor driving past the property, and if they do step foot in the property, they may only spend 5 or 10 minutes in there. So whilst this might be enough time for the lender to decide whether they're happy to lend against it, it's not enough time to decide whether it's the right property for you. And as such, we believe getting an expert in who's on your side to review everything about the property is absolutely crucial. Now, if you're purchasing a new build property, they typically come with a 10-year warranty, and the 10-year warranty ensures that the property is built to a suitable industry standard, and it's also there to rectify any serious issues that may occur during the first 10 years. You may therefore just look to do a snagging list on a new build property. This will ensure all those small issues that crop up once you moved in are found before you've moved into the property and can be rectified. Now, if you're purchasing a second-hand property, you want to get yourself a more in-depth report. There's 3 potential levels of report that are available, and depending on what type of property, how old it is, if there's any ongoing concerns, and if you're looking to do any work on the property, will determine which level of report is right for you. We believe speaking to an expert surveyor who'll be able to talk you through these options is key to making sure you know exactly what you're buying. As well as arranging the surveyor, now is also the time to kick on your conveyancing, or the legal work required to purchase the property. Now, we'd recommend that you select your solicitor early in the process, although you don't formally instruct them until you've got your mortgage offer in hand to avoid any wasted cost. Sometimes, due to pressures from the seller, you may have to instruct them early to get things moving forward, but ideally, you'd want to wait until your finance is secured before incurring any costs. Your solicitor or conveyancer will complete a number of jobs as part of the property purchase. For instance, they'll complete searches, both on yourself, the property and the local area. They'll be checking for flooding risks and for any planning consent that you need to be aware of. Any issues they find will be raised with yourself and the mortgage lender as well. As well as inquiries, they'll also negotiate on the contract. So all those finer details about which curtains are staying, which light fittings are staying, will all be detailed in the contract, and your solicitor will make sure that it's favourable for you. They'll also review your deposit, and they'll need to see proof of this before they can exchange contracts. When they do exchange contracts, this is where you're legally binded to buy the property, so at this point no one can pull out, and you'd typically be paying a 5 or 10% deposit paid at this point. Once contracts have been exchanged, they'll set a day for completion, which is the day that you'll move in. And once that date has been set, the solicitor will let the mortgage lender know and make sure that they've got funds in place, and they'll also arrange for the deposit to be transferred from yourself to them so that everything is ready for completion date. On completion date, they'll transfer the money to the seller's solicitor, and they'll also update Land Registry to confirm that you are now the official owner of that property. And that's it. It's time to get your keys and move into your new home. Now, before you open the champagne and settle into that new property, there's something else for you to consider. Now, you could need to consider you're about to make one of the biggest financial commitments of your life, taking on a large sum of debt that you commit to pay back each month. It is therefore crucial that you ensure that you and your family are able to maintain the roof over your head no matter what may happen. Now, no one knows what is around the corner, never mind what the next 30 or 40 years may bring. And one of the first questions we always ask our clients is, how will you be able to afford your mortgage should your income suddenly stop? Assuming you do not have a magic pot of money, then it's probably recommended to put a plan in place for arranging suitable insurances. This makes sure that if you're unable to work, you can carry on making your mortgage payments and remain in your family home. And if you were to pass away, the debt is cleared and you can pass it on to your survivors without any ongoing payments to be made. Now, we typically find clients spend around 10% of their mortgage payments on arranging adequate insurances. So, as an example, if your mortgage payments are £800 a month, then you'll probably need to budget spending around £80 per month to provide you with peace of mind. Hopefully this video has provided you with lots of information, and you could decide to go through this process on your own. However, many of you may decide that you want expert help and guidance, someone to help you make the right decisions, someone to help you answer any questions that may arise, and also able to introduce you to other professionals who can make the process smoother. And for that, you may want to engage a mortgage broker. By using a broker who has access to the whole of market, that will allow you to find the right deal and the right lender for you. We saw earlier how the amount you're able to borrow can vary widely from lender to lender, so having an expert whole of market broker in your corner can ensure you find the right solution. A broker may also have access to exclusive deals or exclusive lenders that are not always available to the wider public on the high street. And finally, having an expert to help navigate the journey just makes sense. This will be the first time you apply for a mortgage, and even a seasoned property owner may only apply a handful of times in their life. Having an expert who does it as a living, day in, day out, just makes sense. And I always ask the question, why would you not want this? I hope this has been really useful, and I'm sure you've got a lot to go away and think about. We'd be delighted to help support you with a free one-to-one support from an expert in our team. Please fill in the below form or book an appointment, and one of our advisors will make a call, and you can start to plan a custom action plan together, get you started on your journey to buying your first home.